Building wealth doesn't usually come from finding the perfect stock or predicting the next market trend. More often, it comes from following a simple strategy consistently over a long period of time. That's one reason ETFs have become one of the most popular investment tools in the world. They allow investors to own diversified portfolios, reduce risk, and participate in the long-term growth of entire markets without needing to constantly buy and sell individual stocks. Today we will talk about best ETFs for long-term wealth building. So before we get started, make sure to hit that like button. Also subscribe to my channel. 10. ETFs are not get-rich-quick tools, they are wealth-building machines. Exchange-traded funds ETFs are one of the simplest and most powerful tools for long-term investing. But many beginners misunderstand them. They are not designed to make you rich overnight. Instead, they are built to grow wealth slowly, steadily, and consistently over years or even decades. The real power of ETFs comes from diversification, compounding, and discipline. Instead of trying to pick winning individual stocks, you are investing in a basket of companies that can collectively grow over time. This reduces risk while still giving you exposure to the overall market. 9. Broad market ETFs, the foundation of most portfolios. The most important category of ETFs for long-term wealth building is broad market ETFs. These funds track major stock market indexes and give you exposure to hundreds or even thousands of companies in a single investment. The idea is simple. Instead of betting on individual businesses, you invest in the overall growth of the economy. Over long periods, economies tend to expand, companies innovate, and markets grow in value. Broad market ETFs are often considered the foundation of a strong portfolio because they reduce risk and remove the need for constant decision-making. 8. S&P 500 ETFs, exposure to the strongest companies. One of the most popular types of ETFs is those that track the S&P 500 index. These funds include large, well-established companies across various industries such as technology, healthcare, finance, and consumer goods. The advantage of S&P 500 ETFs is that they provide exposure to some of the strongest businesses in the world, without requiring you to pick individual winners. Many long-term investors prefer these ETFs because they combine growth potential with stability. While they still experience market ups and downs, they have historically shown strong long-term performance compared to many other investment options. 7. Total market ETFs, maximum diversification. Total market ETFs take diversification even further by including not just large companies, but also mid-sized and smaller companies. This creates broader exposure to the entire stock market rather than focusing only on the biggest corporations. The benefit of this approach is that you are not relying solely on a small group of companies for growth. Instead, you are investing in the entire ecosystem of businesses that make up the economy. This type of ETF is often favored by investors who want a simple set and forget strategy with long-term potential. 6. Dividend ETFs, building income while you grow wealth. Dividend-focused ETFs are designed for investors who want both growth and regular income. These funds invest in companies that regularly pay dividends, which are cash payments distributed to shareholders. Over time, these dividends can be reinvested to buy more shares, increasing the size of your portfolio and potentially generating even more income. While dividend ETFs may not always grow as fast as pure growth funds, they provide a steady income component that can be useful for long-term financial planning. 5. Growth ETFs, higher risk, higher potential. Growth ETFs focus on companies that are expected to grow faster than the overall market. These often include technology companies, innovation-driven industries, and emerging sectors. The potential upside of growth ETFs can be higher, but they also come with more volatility. Prices can fluctuate significantly in the short term, which can be uncomfortable for beginners. However, over long time periods, growth-focused investments have the potential to significantly increase portfolio value. Many investors use them as a smaller portion of a diversified portfolio to boost long-term returns. 4. International ETFs, expanding beyond one economy. Investing only in one country's market can limit your opportunities. International ETFs provide exposure to companies outside your home country, including developed and emerging markets. Different regions of the world grow at different speeds, and economic cycles do not always move together. By investing globally, you reduce dependence on a single economy and gain access to worldwide growth opportunities. International ETFs can help balance your portfolio and reduce concentration risk, especially in uncertain economic environments. 3. Sector ETFs, targeting specific industries. Sector ETFs focus on specific industries such as technology, healthcare, energy, or finance. These funds allow investors to concentrate on areas they believe will perform strongly in the future. For example, technology ETFs often include companies involved in artificial intelligence, cloud computing, and digital services. While sector ETFs can offer strong returns during certain periods, they also carry higher risk because they are less diversified. They are often best used as a complement to broader ETFs rather than the main foundation of a portfolio. 2. The power of consistent investing and reinvestment. The most important factor in building long-term wealth with ETFs is not the specific fund you choose, it is consistency. Regular investing, often called dollar-cost averaging, helps reduce the impact of market volatility and builds wealth over time. Reinvesting dividends is equally important because it allows your returns to generate additional returns. Many investors underestimate the power of time in the market. The longer you stay invested and continue contributing, the more powerful compounding becomes. Small, consistent investments can eventually grow into substantial portfolios when given enough time. 1. The best ETF strategy is simplicity and patience. The smartest ETF strategy for long-term wealth building is not complicated. It is built on simple principles. Choose diversified funds, invest consistently, reinvest earnings, and stay patient during market fluctuations. Many beginners overcomplicate investing by constantly changing strategies or chasing short-term opportunities. However, long-term success usually comes from doing simple things consistently for many years. ETFs make investing accessible to almost anyone, but the real results come from discipline, patience, and time. Wealth is not created by reacting to the market, it is created by staying invested through it. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.